Welcome to the Vaughan Nelson podcast. Today is the first quarter 2026 Vaughan Nelson Value Opportunity Recap. And with me today is lead senior portfolio manager, Dennis Alff. Welcome, Dennis.
Hey, Dan. It's great to have the chance to talk again and share a couple of notes about the start of the year. The year started out strong for the market and the portfolio as well. Coming out of last year, we had the portfolio positioned around a couple of concepts. We leaned the portfolio into some secular ideas, such as data center construction, power scarcity, and the need for new power generation to support the country's growing demand for electricity. And then finally, commercial aero demand to support the increasing global population that seems very eager to travel and to replace an aging existing fleet. To complement these secular ideas, we also believed that a broadening economic expansion, especially in the manufacturing parts of the economy, was beginning to take shape. And so we positioned significant exposure to what we refer to as early cycle business models that are quick to inflect as underlying conditions improve. The constructed portfolio served us really very well in January and February as we started the year, and we recorded strong absolute and relative performance. Of course, we all know what happened in March as geopolitical concerns took center stage and conflict broke out in the Middle East between the United States and Iran, which sent oil prices soaring and led the market into a drawdown that erased the portfolio's gains from the earlier months as the market took more of a risk-off attitude. The net result of the quarter was a slight underperformance relative to the benchmark, despite posting positive absolute returns. Currently, at this time, the conflict in the Middle East continues to be the main focus of the market. The longer the conflict lasts, the greater the concerns will be about the high price of oil and gasoline and its impact both on businesses and consumers, as well as other supply chain disruptions that, quite frankly, may take a long time to work out. Given these risks, I think it's prudent to think about how to protect the portfolio from a further drawdown and de-risking. With that goal in mind, let's talk a little bit about the month of March and see what worked well and what didn't to see if we can figure out any clues. The market drew down over 5% in the month of March in our part of the universe. That's a fairly material decline for one month and certainly represents a de-risking mentality from investors. Typically, in a de risking market, things like staples, REITs, and healthcare fare best as investors are comforted by these business models that are thought of as more stable and recurring than other more economically sensitive areas of the market. Interestingly, these areas did not perform exceptionally well in March. In fact, for our universe, consumer staples were down almost 10%, REITs were down over 6.5%, and healthcare dropped by about 8%, all of which underperformed the market. So it begs the question, why might these areas, historically thought of as defensive and safer in a market sell off, not perform as well as expected? Certainly, there are many reasons, but one potential explanation is that all of these areas have significant fundamental questions currently surrounding the businesses that exist there. Just generally speaking, at a high level, consumer staples have material questions about price levels after years of raising prices following COVID, and many food companies are facing volume questions with the growing use of GLP-1 medications that are impacting consumer consumption. REITs have struggled with questions about the sustainability of return to work since COVID ended, as well as more recent questions about whether AI agents will reduce the need for white collar employees in office space. And lastly, in healthcare, healthcare has had difficulty sorting through government reimbursement trends and volumes with a changing employment backdrop. In essence, these historically steady businesses have many questions around their current fundamental visibility that perhaps made them less interesting as safe havens in the March drawdown. So, what did perform well in March? Not surprising, but energy and chemical companies posted strong positive returns. Hardly a surprise, as the conflict has sent oil prices higher and forced material levels of chemical capacity in the region to shut down, which is going to benefit the other players. Utilities did well. Again, perhaps not a surprise given the steady characteristics that come with these businesses, as we all need to pay our utility bills. But more interesting, at least to me, is some unexpected areas of the market that performed well in March. Numerous companies that are levered to AI and data center build out perform well, some of them exceptionally well. Some companies with exposure to building new power generation outperform the market. And then there were certain companies tied to the aerospace cycle that also outperformed. In other words, some of these secular themes that we've discussed earlier found themselves acting very well in the market sell off. Why might that be the case? Perhaps it's because the market has stronger conviction that the drivers behind these businesses are extremely stable, even as the geopolitical backdrop continues to intensify. We feel this potentially bodes well for the portfolio. At the end of the quarter, the portfolio held a little more than 50% of its weighting in companies tied to these secular trends. That's a slight increase from the end of the year as we actively reposition the portfolio in this direction through the first 3 months of 2026. We strongly feel that the fundamentals and sustainability of these companies are very strong with valuations that are reasonable. We believe that this will help the portfolio navigate whatever comes next on the geopolitical front by providing protection in the downside like they did in March should conditions deteriorate, and plenty of upside in the future should the Middle East reach peace and supply chains begin to revert back to normal. We feel strongly that the portfolio is in a position to succeed no matter what comes next. Let's leave it at that for now, Dan, and I'll turn it back over to you.
All right, well, great. Well, thank you so much, Dennis. And with that, we will move into returns. In the first quarter of 2026, the Vaughan Nelson Value Opportunity Strategy returned 2.6% gross, 2.38% net, and the Russell Midcap Value Index was at 3.68%. Over the past 1 year, Vaughan Nelson Value Opportunity was returned 21.47 gross, 20.45 net, and the Russell Midcap Value is at 17.62%. Past 3 years, 17.23% for the Vaughan Nelson Value Opportunity Gross, 16.25 Vaughan Nelson Value Opportunity Net, and 13.14 Russell Midcap Value Index. Past 5 years, 10.42% to Vaughan Nelson Value Opportunity Gross, 9.5% Value Opportunity Net, and 7.94% for the Russell Midcap Value Index. And in the past 10 years, the Vaughan Nelson Value Opportunities returned 10.95 gross, 10.01 net. The Russell Midcap Value Index is at 9.76. And with that, that's a wrap on the first quarter. So thank you so much, Dennis, and we'll hear from you again soon.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.